Hello, everybody. This is Patrick MontesDeOca with the Equity Management Academy live weekend podcast for October the 8th, 2021. Gold and Bitcoin entering stagflation waters. Equity Management Academy, mean reversion trading. Summary. The unemployment numbers were about 190,000, expecting about 500,000 new jobs. There is a high probability that the economy will go into a slowdown in the fourth quarter. With this news, it's going to be difficult for Chairman Powell to raise rates or taper. I said, quote, we have conflicting fundamentals with inflation fears based on supply chain shortages and a slowdown in the economy. Is it stagflation? That is what it sounds like, but let's see how the market reacts, end of quote. This idea was discussed in more depth with members of my private investment community, mean reversion trading, in Seeking Alpha. Fundamentals. The government just announced that unemployment claims finally fell to month, but 4.2 million Americans continue to receive benefits. The labor market appears to be struggling somewhat less than expected, but about twice as many Americans are on the benefits than before the pandemic. The unemployment numbers were about 190,000, expecting about 500,000 new jobs. It's a surprise. I said, so it has taken the argument of the Fed to taper or raise interest rates off the table. There is a sign, there is a high probability that the economy will go into a slowdown in the fourth quarter with this news. It's going to be difficult for Chairman Powell to raise rates or taper. I expect rates to go down, far more than people expect. We may be talking about lowering rates or using some sort of repurchasing agreement to manipulate the yield curve and synthetically bring down the long-term interest rates. I said we have conflicting fundamentals with inflation fears based on supply chain shortages and a slowdown in the economy. Is it stagflation? That's what it sounds like. But let's see how the markets reacts. With any talk of tapering or raising interest rates off the table, we recommend buying gold and silver on the pullbacks. Since the long-term trend for precious metals is bullish, I said if gold comes down to 1749 or 1750, that is an excellent high probability trade. Gold. Gold is showing a lot of trading activity. I said our proprietary artificial intelligence algorithm, the variable changing price momentum indicator, forecasts a 20% increase in gold in the next few months. However, gold may move down to 1707 to 1656, again, before it moves back up. We may make the annual lows over the next few weeks. For the monthly VCPMI gold report, with gold closing below 1785, the trend momentum was bearish. A close above 1785 will negate this bearish momentum to neutral. The monthly price momentum of 1772 was also bearish. So this is the price velocity within the bigger trend. And a close above 1772 stop now will negate this bearishness to neutral again. On the downside, the monthly targets are the buy levels of 1707 and 1756 for the rest of the month. If we trade back up through 1772, we have targets of the sell levels above the mean of 1823 and 1888. We are getting a daily and weekly short trigger from 1777 and 1774 after taking profits at these levels. The targets is the daily average of 1759. With the economic news, it is a fast market in gold is coming down to support levels. 1750 and 1749 mark a harmonic alignment between the daily and the weekly numbers. 1750 is the daily buy one level of support, and 1749 is the weekly average price. So I said they form a strong area of harmonic convergence, making the highest probability entry points for a trade. Bitcoin. With the VCPMI targets for Bitcoin have been completed from 51,245 to 53,935. We have completed the sell one level of 56,082. The next VCPMI target is 57,438. On the daily, we met the sell one target and reverted to a short trigger. It then met the daily mean target and has activated a bearish price momentum. The target is the buy one level of 53,612. Right below the daily mean is the weekly sell two level of 53,935. If we go below 53,935, it will activate a bearish trigger within the daily pattern. We use pivot points, but we go beyond the basic technical analysis and interpretation. The VCPMI AI incorporates moving averages, Gann, and Fibonacci formulas, reversion to the mean principles, and other analytical approaches to produce the pivot points that the VCPMI algorithm highlights. At the sell one and buy one levels, there is a 90% chance of the market reverting from those levels to the mean if activated, while the sell two and buy two levels have 95% probabilities of the market reverting from those levels to the mean. 50-50 standard deviation. These levels indicate the highest probability trades. They are not 100% guaranteed, but they indicate the highest probability trades. It provides a clear structure for your trading, I said.
Thank you for listening. If you want to learn more about what we do, please go to the Equity Management Academy, email to trade.com, or listen to any of our previous episodes.
Good morning, everybody. This is Patrick MontesDeOca here with the Equity Management Academy live trading room. I wanted to share that report with you, which gives us a pretty good idea of the structure of the market here for this week. We have a reversion in gold unfolding here above the daily average of 1762. It negated the short trigger signal that came in here from the sell one level here that we saw earlier. And where we are right now, we're basically in a level, what it's called distribution of supply, a level of resistance. Although this signal here was negated, and we took a loss in here for the time being. We got out and waiting for the market to either run up to 1778, which is the weekly now sell one level,
um, or come down again and activate a short trigger here from the sell 1 daily level that we're looking at. I want to share with you a report here that came out this morning. Regarding the IMF cutting global growth outlook as supply bottlenecks hobble pandemic. Persistent supply chain disruptions and pricing pressures are constraining global growth. It's constraining the global economy, the economy's recovery from the COVID-19 pandemic. The International Monetary Fund said on Tuesday that as it cut growth outlooks for the United States and other major industrial nations. In its World Economic Outlook, the IMF trimmed its 2021 global growth forecast from 5.9 to 6%. It left the 2022 global forecast unchanged. And I believe it could be, any number of fundamental reasons right now why this reversion occurred fundamentally, and it's very difficult to trade the markets fundamentally. It's been very difficult to trade the markets fundamentally for the past year since the pandemic in March 2020. And we're beginning to see another crisis, and in fact, not only another crisis, but we seem to have a few potential black swans on the horizon. We have the debt limit coming up. We have the Feds, the FOMC, trying to identify what to do with interest rates. Are they going to taper or not taper? Raise interest rates, not raise interest rates? I don't think you have much difficulty if you just take a look at the economic growth globally now, which indicates a slowdown in the economy. There is no way in the world that central bankers are going to raise interest rates. Not with the amount of debt that we have globally, which exceeds 100% of GDPs globally. So the idea that interest rates are going to go up, I think, is far-fetched at this point, or any kind of indication policy changes by the Feds to raise interest rates, I believe, is out of the table. Tapering, it's a question of how they manipulate the yield curve in terms of whether they can taper or where can they taper, and if they can taper under the current economic conditions. My belief my belief is that this is going to put a lot more pressure for central bankers to continue to maintain interest rates negative. So we have a situation where basically demand is very strong. People are anxious to get back into the economy. They want to go out to restaurants. They want to go out to the movies. They want to come back to a normal life. We've been, locked down for, gosh, it seems forever here in the ability to have a normal, free lifestyle. And so there is a lot of pent-up demand that is coming out into the market on the face of a shortage of just about everything that you can imagine. And that to me is a sign that we're in some kind of stagflation where prices are going through the roof because we can't get supplies and we have a bottleneck of supplies. It's hopefully a short-term situation. But in the meantime, we have a huge holiday period, a couple of holidays coming up real soon. And it's going to be difficult to have a normal life. And it remains to be seen, to what degree demand is going to push prices under the current conditions. So I don't believe that interest rates are going up, or they can go up. So we may get a lot of talk from the Fed's politicians here regarding interest rates. They politicized this debt ceiling, which inevitably they're going to have to increase now. There is no question that more stimulus has to come into the market. The market is not, the economy is not where it should be. It's dislocated, obviously, with supplies. We have a shortage of supplies due to a ship problem that we have. The ships are on the dock. They're waiting to deliver the product, but where is the labor? We have a labor problem. And that begins to fit into an increase of wages, which becomes more permanent. Because once you increase wages, very difficult to go back. So the labor force is putting a lot of pressure to the system to increase wages, and we're beginning to see some companies increasing their minimum wages by $1 or $2. And one of the things that obviously is could potentially be a problem is that once this gets pretty much integrated in the economy, it's a factor that's going to stay with us for quite some time, until things begin to get normal and the supply chain begins to normalize. So I believe we're going to see another crisis unfolding here as we move into the end of this year. On top of that, we have, Evergrande's China, or one of the world's largest real estate developer, potentially defaulting. Fantasia is another Chinese developer that potentially is on the verge of defaulting. And so we have an international potential crisis unfolding in China's economy. And the problem with China is that they are not completely transparent with their numbers that they publish regarding the economy. So we really I believe, are in the dark with the truth regarding China's economy. And that adds another risk to the global economy in terms of who is potentially at risk, of getting involved or attached or invested in this ventures, this Chinese ventures that potentially can default. Are individual institutional traders or banks, or that yet it remains to be seen. And so we are getting a little volatility here in the gold market, but I don't think that this is the place where we're going to see an explosion occur. The market is, in terms of the technical aspect of the market, if we take a look at obviously and compare the fundamentals with the technical aspect of the market is trading purely on technicals as opposed to the fundamentals. It hasn't reacted to all of these fundamentals, across the board. Not to mention the fact that commodities once again are exploding. Cotton, basic goods commodities now are going to be affected. And it remains to be seen again, what kind of harvesting are we going to have, what kind of just basic commodities made available here. So I think we're still moving through a process of what I call recalibration in the system, where everything is adjusting itself to its current value based on its supply and demand and its in the market relationships, which is where I look at gold, for example, and I cannot continue to say that while the price is down here, you got to buy some of these assets, which are gold, silver, which are real monetary assets, as we continue to see a deterioration in the monetary system, in the currency system. It appears that the path of least resistance is going to continue to be printing currency. And the more you print fiat currency, the more it's going to devalue the value of its currency. And that is going to be, and it's becoming inflationary. The problem is that it could enter into a hyperinflation acceleration level that may not be able to be stopped. Particularly as we compare to gold or silver, some of these assets are way, way above its mean. Or I should say, gold and silver as monetary assets are completely undervalued to its mean, to the value of the intermarket relationship to crude oil now, which may be going to $100 a barrel. And that is not good for the economy. We have all this now factors beginning to pressure the growth of the economy, and crude oil going up, it's like a tax on the economy. So it just validates more and confirms more that the Fed's central bankers cannot raise interest rates. So the alternative is a complete chaos in the world economy and going into a deep recession globally. And God knows where that could lead us to. So we're not out of the woods yet, in my opinion, and the markets are telling us that. But while the price of gold and silver is down here, it is an incredible opportunity to accumulate and do it smartly, because the monetary base is being debased. It's being undervalued as a consequence of all this printing of money, due to the fact that obviously the policy seems to be to monetize the debt to just pay for the interest on the debt, not the principal, never mind the principal, just the interest on the debt is going to be a tremendous burden as we move ahead. And so I believe that we are entering a period where the US dollar is going to accelerate to the downside more and more. It already has reflected all of that in what we're looking at as far as prices of real estate assets and other related assets, counter inflationary, that have just exploded. So, but I'm not so sure that these levels can be sustained. I think we have a great deal of speculation in the market. Interest rates coming down to where they are, I believe, has created a tremendous leveraged bubble that I don't believe we know yet the extent of the leverage until it breaks. For example, Evergrande, we are beginning to find out their liabilities, their leverage factor. And, leveraging seems to be the tool that is used. It has to be used in order to create the liquidity that our government has been able to do in order to save this economy from, collapsing. Fortunately, they've been able to do that, and it has saved or created a safety net underneath the markets. But the markets can't live on, government subsidies. They can't live on stimulus alone. And we're going to have to allow at some point, and I think that is coming around the corner, to let the markets trade based on free market enterprise. Let the markets do what they're going to do, adjust as they need to, and find some transparency and values in the markets, and get back to a solid base, of a market condition, not a highly leveraged, highly risk condition that if we have any bumps on the road, we're going to experience a severe whiplash. So things are pretty delicate right now, and I think the gold market is beginning to see that, in fact, we're not going to raise interest rates, and the argument of higher interest rates for the price of gold is eliminated out of the equation. So continue to be patient here, and sometimes we can't be right all the time when we day trade, but the overall underlying trend in the market is our friend, and I think we are in the process now of building what could be the annual law for 2021. Thank you again, everybody, for the opportunity to share this info with you, and I hope you have a great trading day. I hope you have a great week. Be safe, and I'll talk to you soon. Take care.